In order to quantify the impact of the operating risk, we can measure it by the degree of operating leverage or DOL. DOL is an elasticity measure or a measure of the operating income sensitivity to changes in the quantity of products sold. So, it is the ratio of percentage change in operating income to the percentage change in units sold. To better understand the degree of operating leverage, we need to get into details of the operating income. Operating income is equal to revenues minus total operating costs. Thus, operating income is equal to price per unit multiplied by number of units sold minus variable cost per unit multiplied by number of units sold minus fixed operating costs. Each unit sold covers its variable cost in addition to a portion of the fixed costs. This is the per unit contribution margin, which is calculated as the difference between the price per unit and the variable cost per unit. Multiplying this difference by the number of units sold results in the contribution margin. In other words, it is equal to the total revenue minus total variable costs. Fixed costs remain constant as the quantity of units sold changes. Therefore, notice that the operating income changes by the contribution margin. We can conclude that the DOL is the contribution margin divided by the operating income at a certain level of units sold. Then DOL is equal to Q times P minus V divided by Q times P minus V, minus F, where Q is the number of units. P is the price per unit. V is the variable operating cost per unit. And F is the fixed operating cost. Let's continue with the company example. Suppose it sells 150,000 units. DOL would be equal to 150,000 times 15 minus 3 divided by 150,000 times 15 minus 3 minus 750,000, which equals 1.71. A DOL of 1.71 implies that a 1% decrease in units sold leads to 1.71% decrease in operating income, and vice versa. However, DOL differs based on sales levels. For 300,000 units, DOL is equal to 1.26. It is worth noting that the operating income would be highly sensitive to the changes in the quantities sold when it is just above or just below zero, as the DOL would be too high. This graph shows the change of the degree of operating leverage as the quantity of units sold changes for Company A. The company's operating income is at levels near zero around the level of 62,500 units sold. So, the DOL in absolute terms increases dramatically around this value. Let's take another example of Company A to see the effect of the shift of fixed costs to variable costs on the degree of operating leverage even when the quantity produced and sold, price per unit and total costs remain constant. Assume in the second year Company A shifts $150,000 of fixed costs to variable costs such that the variable cost per unit is $4 and the fixed cost becomes $600,000. The degree of operating leverage in the first year was computed to be 1.71 while in the second year it is equal to 1.57. So, as the portion of the fixed cost out of total cost decreases and shifts to variable costs, the degree of operating leverage decreases. Thus, the sensitivity of operating income to changes in quantity sold decreases. Find the full business risk video on www.cognivisio.com.